Imagine wrapping up your best freelance year ever, then opening a CRA letter in April asking for $8,000 you weren't expecting. That's not a horror story. That's Tuesday for most new self-employed Canadians. Here's why it happens, and exactly how to make sure it never happens to you. Before we get into the numbers, I put together a free 2026 Canadian Money Moves checklist covering everything we talk about on this channel. Link in the description if you want it. Now, installment payments. When you work a salary job, your employer remits your income tax to the CRA every single paycheck. The government gets its money in a steady drip all year long. But when you're self-employed, nobody's withholding anything. You collect the full payment from your clients, and the CRA expects you to voluntarily send them their cut 4 times a year, rather than one enormous lump sum on April 30th. These quarterly payments are called tax installments. According to the CRA, they exist specifically so that self-employed Canadians, freelancers, contractors, gig workers, don't build up a massive tax debt over 12 months and then get blindsided. The system makes sense. Most people just don't know they're in it. So who actually has to pay? According to the CRA, the trigger is your net tax owing. If you owed more than $3,000 after filing, meaning after all your credits, deductions, and any tax already withheld, in either the current tax year or either of the 2 previous years, the CRA expects you to pay by installment. That $3,000 threshold applies to every province except Quebec, where the provincial threshold drops to $1,800. And here's the part most people miss. The CRA might not even send you a reminder. They may issue installment reminders, but they are not required to. So if you clear that $3,000 threshold and skip the payments, the CRA assumes you knew. Ignorance is not a defense they accept. The math says, if you're earning more than roughly $30,000 to $40,000 in self-employment income with no other withholding, you're almost certainly in installment territory. The CRA gives you 3 ways to calculate your installments. First, the prior year method. Take what you owed last year, divide by 4, pay that each quarter. Second, the current year method. Estimate what you'll owe this year, divide by 4. Third, the CRA's own no calculation method. They send you figures based on 2 years of filing history. Here's the actual number on why the prior year method is the safest starting point for most freelancers. As long as you pay what you owed last year in equal quarterly chunks, the CRA will not charge you installment interest, even if you end up owing more at filing time. You'll just pay the difference in April. If you had a breakout year and your income jumped significantly, switch to the current year method and estimate conservatively, meaning estimate high, not low. Underestimating triggers interest and penalty charges. The math is simple. The discipline is the hard part. 4 dates. That's all you need to memorize. For 2026, your installment due dates are March 15th, June 15th, September 15th, and December 15th. Miss one, and the CRA starts charging installment interest from that specific missed date, not from April filing. That's the mistake that costs freelancers real money. According to the CRA, installment interest compounds daily at the prescribed interest rate plus 4%. Right now, that's not trivial. 2 common mistakes here. First, people assume the June payment can wait until their June 15th tax filing extension. It cannot. Those are completely separate deadlines. Second, people treat December 15th as optional because it's close to year-end. It is not optional. The CRA does not grade on holiday spirit. A practical move. Set 4 recurring calendar alerts right now for those dates. Treat each one like a rent payment, because to the CRA, that's exactly what it is. Knowing when to pay is half the equation. Knowing where to keep the money until then is the other half, and most people get this wrong. Here's the strategy. Every time a client payment lands, immediately transfer 25 to 30% into a separate high-interest savings account. Not your checking account. That money will evaporate. A dedicated savings account creates a visual and psychological barrier. EQ Bank's TFSA savings account earns a competitive interest rate on deposits, meaning your tax savings are actually stacking small gains while they wait. That's money the CRA can't touch, and money you're earning on funds you were going to hand over anyway. In the U.S., the equivalent move is parking estimated tax funds in a high-yield savings account before quarterly IRS payments. Same logic, same discipline. The goal is that by the time each installment date rolls around, you're not scrambling. You're just transferring money that was already set aside and already working. That's the difference between a stressful tax season and a boring one. Here's the short version of everything we covered. Know your net tax owing threshold, pay on the 4 installment dates, and park your tax savings somewhere that earns interest while it waits. For the savings account, EQ Bank's TFSA is where we'd start. For investing anything beyond your tax reserve, whether that's TFSA contributions, RRSP, or FHSA, Wealthsimple and Questrade both offer commission-free ETF investing for Canadians. Links to EQ Bank, Wealthsimple, and Questrade are in the description. And if you want the full 2026 Canadian Money Moves checklist, including installment dates, set-aside percentages, and write-off reminders, that's free at the link in the description. Follow the Gain channel for weekly Canadian money breakdowns.